business credit cards that don't require strong personal credit, an in-depth strategic guide. A quick note before we continue: ads may play during this video. Your support keeps this content free. Now let's jump in. If you've been told you can't access business credit because your personal FICO score isn't where it needs to be, this video is going to reframe everything you think you know about how credit actually works inside a business entity. What I'm about to walk you through is the same architecture that corporate finance consultants use with mid-market clients. The kind of strategic guidance that typically costs several $1,000s to access inside a paid advisory engagement. So if you're building a business and you've hit a wall with traditional credit underwriting, stay with me. By the end of this video, you will understand exactly which business credit products are structured to underwrite your company, not your personal credit history. You will know how to architect your entity to qualify for non-recourse credit facilities. You will understand the tax treatment of business credit expenses and how to use float periods to improve cash flow timing. And you will have a clear strategic pathway to migrate your business from personal guarantee dependency to true corporate credit independence. Let's start at the foundation. The single most misunderstood concept in small business finance is the difference between personal guarantee credit and entity-based credit. When a lender or card issuer requires a personal guarantee, they are essentially saying, "We don't trust the business enough to underwrite it alone, so we need your personal liability as collateral." This matters enormously from a liability architecture standpoint. Every card tied to your personal social security number and personal credit report creates what tax attorneys call piercing risk, a legal and financial entanglement between your personal balance sheet and your corporate balance sheet. What I'm calling the personal guarantee versus entity credit distinction is not just semantic. It is the difference between protecting your personal assets and exposing them. The good news is that the market has shifted. A new generation of fintech-native corporate card issuers has built underwriting models that evaluate your business independently. They look at revenue, bank account balances, business age, and operational cash flow, not your personal FICO score. This opens a strategic pathway for business owners who are either rebuilding personal credit, who are new to the U.S. credit system, or who simply want clean liability separation between their personal and business financial lives. The first product that deserves serious institutional analysis is the Brex business card. Brex was built specifically to underwrite businesses without requiring a personal guarantee. Their model uses what they call cash-based underwriting. They connect directly to your business bank accounts and evaluate your average daily balance and revenue patterns. For S Corp and C Corp owners who maintain 3 to 6 months of operating capital in their business accounts, Brex's entity-only underwriting framework is one of the most powerful tools available for separating personal liability from corporate credit exposure. From a capital efficiency standpoint, the Brex business card offers category-based rewards, including elevated returns on software subscriptions, travel, and advertising spend that align naturally with early-stage and growth-stage company expense profiles. More importantly, because Brex reports exclusively to business credit bureaus like Dun & Bradstreet and the Small Business Financial Exchange, every dollar you put through this card is building your corporate credit profile, not your personal one. For business owners executing a deliberate credit migration strategy, this is the mechanism that creates separation over 12 to 24 months of consistent usage. One institutional-grade consideration. Brex typically requires that your business banking be conducted through their partner institutions, or that you maintain a minimum average balance. For LLC owners and C Corp operators generating at least $10,000 monthly in revenue, the threshold is generally manageable. Consult with a qualified financial advisor to confirm your specific entity qualifies under current underwriting guidelines. The second product in this framework is the Ramp Corporate Card. Ramp operates on a similar entity-first underwriting model, but differentiates itself through its integrated financial intelligence platform. What makes Ramp strategically interesting is not just the credit access. It's the cash flow intelligence layer built into the product. Ramp's platform analyzes your business spending in real time, identifies duplicate subscriptions, flags vendor pricing anomalies, and generates expense reports that align directly with IRS substantiation requirements under Treasury Regulation 1.274. For business owners who are trying to optimize EBITDA, that last point is significant. The IRS requires that business expense deductions be substantiated with adequate records, meaning the amount, time, place, business purpose, and business relationship for each expense. Ramp's automated receipt matching and categorization system creates a defensible paper trail that holds up to audit scrutiny, which means you are not just accessing credit. You are simultaneously building compliant expense documentation as part of your tax strategy. Ramp, like Brex, does not require a personal guarantee for qualifying businesses. Their underwriting evaluates your business bank balance and cash flow history. Ramp also reports to commercial credit bureaus, continuing the entity credit building process without touching your personal report. The third product worth serious analysis is the Divvy Corporate Card, and this one serves a slightly different financial profile than Brex or Ramp. Divvy, now operating under the Bill financial infrastructure, uses a dynamic credit limit model that adjusts based on your business's cash position and payment behavior. What I mean when I reference the Divvy card's variable credit architecture is this. Rather than issuing a fixed credit line, Divvy gives you a credit allocation that scales with your demonstrated ability to pay, which creates a feedback loop that rewards disciplined treasury management. For business owners who are earlier in their entity credit building journey, perhaps operating a sole proprietorship converted to an LLC within the last 12 to 24 months, Divvy's model is accessible at lower revenue thresholds than Brex or Ramp typically require. The trade-off is that Divvy uses a weekly payment cycle for some users, which compresses your float period. A float period, for those unfamiliar, is the time between when a charge is made and when it must be paid. Longer float periods are a cash flow management tool. They allow you to time your outflows against your inflows more precisely, which has real working capital implications for businesses with lumpy revenue patterns. Now, not every business is operating at the revenue levels that pure entity-first issuers like Brex or Ramp require. For businesses in an earlier stage, generating revenue, but not yet at the scale that pure fintech corporate cards prefer, the Capital One Spark Cash Select for Business represents what I'd call a hybrid underwriting model. Capital One does use personal credit in their underwriting for Spark products, but the approval thresholds are meaningfully lower than what you'll find with Chase or American Express business products. More importantly, Capital One Spark line reports business activity to commercial credit bureaus, which means you can use this card as a bridge instrument, building business credit history while your entity scales toward the revenue levels that qualify for non-recourse facilities. From a cost basis reduction standpoint, the Spark Cash Select offers a flat cash back rate with no annual fee, which creates a predictable and simple tax treatment. Every cashback dollar received is a reduction in your cost basis for the expense, not taxable income in most scenarios. That simplicity is actually a strategic feature for business owners who want clean, auditable expense records without complex points valuation methodologies. Let me now address the strategic architecture that underlies all of these products, what I call the EIN-only credit building pathway. An employer identification number, or EIN, is to your business what a social security number is to you personally. It is the foundation of your corporate credit identity. Building credit under your EIN, independent of your SSN, requires a deliberate sequence. Establishing your business with the state, opening a dedicated business checking account, registering with Dun & Bradstreet to obtain a DUNS number, and then systematically opening trade lines and credit products that report to commercial bureaus. Every product discussed in this video contributes to that EIN credit profile when used consistently. The institutional insight here is sequencing. Businesses that attempt to jump immediately to high-limit corporate facilities without an established commercial credit file will face rejection regardless of their revenue. The pathway is: establish identity, open trade accounts with net 30 vendors, layer in corporate card products like Brex or Divvy, and then, after 12 to 24 months of on-time payment history, you have a commercial credit file that supports more sophisticated financing. Here is where the institutional-grade analysis becomes particularly valuable. Business credit cards, used strategically, are a tax timing tool. For business owners operating on a cash-basis accounting method, which most small and mid-sized businesses use, an expense is deductible in the tax year it is paid, not when it is charged. This creates a meaningful planning window when combined with float periods. If you charge a significant business expense on December 28th on a card with a 30-day billing cycle and a 25-day payment window, that payment may not clear until late February of the following year. But the expense is still deductible in the year it was charged, because the charge represents your intent and obligation to pay. The tax timing and float period strategy I'm describing here, recognized within standard cash basis accounting, can shift the timing of taxable income and deductible expenses in ways that meaningfully reduce your effective tax rate in high-revenue years. Consult with a qualified CPA or tax attorney to apply this appropriately to your specific entity structure and accounting method. One of the most important structural decisions a business owner makes is how to maintain true liability separation architecture. When you use a personal credit card for business expenses, even if you track them perfectly, you are commingling personal and business financial activity in ways that courts and the IRS can use to pierce the corporate veil. Corporate veil piercing eliminates the liability protection that an LLC or corporation is designed to provide. Business-only credit products, especially those tied exclusively to your EIN and business bank accounts, reinforce the legal and financial separation that protects your personal assets. For executives, retirees investing in business ventures, and established business owners adding new entities, this liability separation architecture is not optional. It is foundational. Every dollar of business expense that runs through a personal credit instrument is a dollar that weakens your structural firewall. A final strategic mechanism worth understanding is utilization ratio management. Personal credit scores are significantly affected by credit utilization, the ratio of your balance to your available credit limit. By migrating business expenses to EIN-based corporate cards that do not report to personal credit bureaus, you are simultaneously building business credit and protecting your personal utilization ratio. For business owners who will eventually need personal mortgage financing, investment property loans, or other personal credit instruments, Keeping business spend off personal reports can meaningfully preserve personal credit scores. Before we end, let me summarize the critical information from this analysis. First, the distinction between personal guarantee credit and entity-based credit is a liability architecture decision, not just a credit strategy. Protecting your personal assets requires deliberate separation of your corporate financial identity. Second, Brex and Ramp represent the leading entity-first underwriting models available to businesses with established cash flow. Both report to commercial bureaus, build your EIN credit profile, and require no personal guarantee for qualifying businesses. Third, the Build Divvy corporate card serves an earlier stage business profile, offering dynamic credit access at lower revenue thresholds while still building commercial credit history. Fourth, the Capital One Spark Cash Select functions as a hybrid bridge instrument for businesses not yet at the revenue scale required by pure fintech issuers, offering simple cash-back treatment and commercial bureau reporting. Fifth, float periods are a tax timing tool, not just a convenience feature. When aligned with cash basis accounting methodology, they create legitimate planning opportunities for deduction timing. And sixth, every business credit product you use should be evaluated not just for its rewards or terms, but for how it contributes to your EIN credit file, your liability separation architecture, and your long-term cost of capital. Verdict: the strategic pathway from personal guarantee dependency to true corporate credit independence is not a matter of finding one perfect card. It is a sequenced institutional framework, establishing identity, building commercial history, migrating expenses off personal instruments, and layering in progressively sophisticated credit facilities as your entity matures. The products covered in this video represent the most accessible and strategically sound entry points into that framework available in the current market. Please subscribe for more free institutional-grade analysis and credit card strategy that you won't find anywhere else on YouTube. Click the thumbs up button to like if this video has provided value, and comment below with your questions or content requests. Disclaimer: I am not your financial advisor. This content is for educational purposes only. Consult with qualified professionals before making any financial decisions.